Good morning, everyone. This session will cover the long-form audit report, what the key sections are within it, what should auditors be doing to ensure that it is understandable, and what questions should the audit committee be asking around the audit report. I will also briefly talk about the audit report findings the authority has identified in the recent past and what impact, if any, they would have on the work of audit committees. To kick off the session, I have two Slido questions I would like you to answer. Do you read and understand all sections of the audit report? And secondly, do you find that the long-form audit report has led to increased understanding in the work of the auditor? I hope that audit committee members here today respond honestly to the first question. Given the volume of information that goes into audit committee packs, some sections can get glossed over, including standard sections of the audit report. So in today's session, I will give a high-level overview of those key sections. For the second question, do you find that the long-form audit report has led to increased understanding in the work of the auditor? That was certainly the intent of the long-form report, but again, when faced with a large body of text, the mindset can be, this is the auditor's own report and they are responsible for it. Also, some of the terminology can be intimidating for some committee members, especially if they're from a non-audit background. My key message today would be to ask the question to your auditor if you are unsure about any section of the audit report. So if we maybe move just to the responses now and see how truthful they were. So do you read and understand all sections of the audit report? A resounding yes there for 80%, which is very positive. We still have a number there, some honest members saying 4% said no. The second question, did you find that the long-form report has led to increased understanding? Certainly a more mixed bag here. 42% indicating that it did lead to increased understanding, but somewhat 36 and no 23. So hopefully what I'm going to talk about today might try and balance that out more in towards the yes category. Okay, if we move back to the slides. In the 17th of June 2016, the European regulation saw the introduction of the long-form audit opinion for PIs. It was introduced to make the information provided in the audit report more relevant to users. It was also hoped that it would allow for better dialogue between the auditor and those charged with governance, and also explain further the audit process and the audit work that was performed. So what are the key sections of the long-form audit report? I realise that most audit committee members are very familiar with these areas, so I won't go into too much detail, but I will try and give a short overview of each area with a particular focus on the CAMs, or the key audit matters. The opinion, the most important paragraph of the entire report, sets out the final opinion of the audit and whether or not the financial statements present a true and fair view of the company. Is it a clean opinion, or is the opinion qualified? The basis for opinion sets out the auditing standards under which the opinion is based. There is also an independent statement and the confirmation that the auditor believes the audit evidence obtained is sufficient and appropriate. Three key aspects of the long-form report are the CAMs, or key audit matters, the statements on materiality, and scope. These requirements stem from Auditing Standard 701, Communications on Key Audit Matters. The CAMs set out the matters of most significance in the audit of the financial statements. They usually cover areas of higher risk of material misstatement, areas that require significant audit judgment, and significant events or transactions that have occurred in the period. The auditor is required to state why they are significant and how this was addressed within the audit. There are further requirements to provide a description of the significant risks of material misstatement, a summary of the auditor's responses, and any key observations. For materiality, I won't go into too much detail here, as one of my colleagues, Kieran, will cover materiality as it goes through the results of a recent materiality survey amongst audit committees and auditors. I will say that the materiality threshold and performance materiality threshold, the judgment made in determining materiality must all be included in the report. An overview of the scope of the audit must also be included in the auditor's report. The going concern disclosure, that stems from a separate auditing standard, IASA 570. It requires auditors to include in the audit report a statement that the auditor has not identified a material uncertainty that may cast significant doubt on the entity's ability to continue as a going concern. A conclusion that management's use of the going concern basis of accounting is appropriate. An evaluation of how the auditor evaluated management's assessment of the entity's ability to continue as a going concern. For entities that applied the UK Corporate Governance Code and the Irish Corporate Governance Annex, to comment on the director's going concern statement in the director's report. And I suppose maybe just to caveat, this is all for audit opinions that where the basis of the opinion of going concern is appropriate. The responsibilities of management and those charged with governance detailed in the audit report is lifted straight from legislation and include the following. Management's responsibility for the preparation and fair presentation of the financial statements. Management's responsibility over internal controls, controls specific to the financial reporting. Requirements to assess the company's ability to continue as a going concern. And responsibility for overseeing the company's financial reporting process. Similarly, the auditor's responsibilities are straightforward. Obtain reasonable assurance on whether the financial statements as a whole are free from material misstatement, and also to issue an auditor's report that includes their opinion. There is some important terminology within the first bullet point. Reasonable assurance. It is a high level of assurance, but it is not a guarantee that an audit will detect material misstatement. And material misstatements, those misstatements which could influence the economic decisions of users. I think these distinctions are very important in the context of the wider public's perception of what an audit does. There is no certainty that an audit will detect fraud or error. Audit procedures are designed to identify material misstatements, but they're not infallible. What can auditors do with these sections to make audit reports more readable, more understandable, and more relevant? Given that the IASA's, the accounting auditing standards and company law set out a number of key disclosures that cannot be omitted, a carte blanche approach cannot be taken. But these required disclosures themselves should not detract from the readability of audit reports. Clear, concise language is important, especially relating to items specific to the entity. The benefits of this cannot be understated. When we are dealing with sometimes complex areas with significant risk attached, the auditor should be trying to present this in as simple as possible terms. We've seen some good examples of the use of infographics when looking at scoping and materiality, and I will go through some examples now. This first is an extract explaining materiality as compared against one of the key reporting metrics, revenue. The extract comes from the audit report of a large building materials manufacturer and supplier. In this example, we have an extract from the audit report of another building materials manufacturer. This graphic explains the scoping coverage in terms of profit before interest and tax, revenue, and also total assets. In 2020, we published a thematic review on ISA 701, the ISA relation to CAMS, which looked at the reporting of CAMS in 22 PI audit reports across multiple industries. Some of the points I will now talk about stem from this thematic review. I'll start with some key questions for the audit committee or the auditor. How many CAMS should there be? this is entirely the judgment of the auditor. The thematic review saw between 1 and 8, depending on the industry and sector. Is the CAM sufficiently granular, and does it contain any generic language, especially around the description of the risk? Are the key observations of the auditor also specific to the risk? Moving on to IAASA inspections, 44 findings were identified in relation to audit reports over the past number of years. In relation to CAMs, the findings included the stated work performed did not describe the actual work performed. So audit procedures were either not performed or performed in a different manner. Including CAMs in the audit report that were not in the report to those charged with governance, i.e. the additional report. Again, it goes to understandability and consistency. Non-identification of a significant matter which may or should have been reported as a CAM. Not including references to relevant financial disclosures in the CAM. This is at the lesser end of a finding, but nonetheless still a breach from an accounting or auditing standards perspective. The following are more general findings in respect of the audit report. Audit work undertaken that does not support statements made in the audit report, especially the statement that the financial statements are prepared in accordance with the applicable financial reporting framework. In many cases, we identified insufficient audit procedures to make that determination, or we identified clear gaps in IFRS disclosure requirements that were not addressed. Not having the required disclosures in the audit report as required by auditing standards or company law, a template by the audit firm would have addressed this. Some of the more serious or more basic findings identified were the backdating of an audit report, the incorrect name of the entity on the audit report, and finally the date of initial appointment not being correct. So what are the key questions audit committees should be asking their auditor? Have the CAMs been satisfactorily explained to the audit committee? Did the audit committee challenge on whether the CAMs presented in the audit report or the draft audit report were the most appropriate? These are the auditor's key audit matters, but you should, as audit committee members, be comfortable with their completeness. Is the audit opinion consistent with the additional report to the audit committee? Do I understand the basis of materiality and or has the auditor clearly explained it to me? The long form report is not, as I've heard it described, more supplementary text that the auditors can cover themselves with. I don't believe that is the purpose, and when well written or well crafted, a long form audit report can provide good insight into the work performed by the auditor. I recently gave a talk to one of the audit firms as part of their audit quality training workshops. The question was asked on how audit committees assess audit quality and the degree of challenge presented to the auditor on their audit. Auditors, for the most part, want to be challenged on their work. They see it as an integral part of the process, and it keeps them focused on the key risks and issues. The audit report is the key document that the auditor produces, so I would encourage you all today to revisit the audit report and to challenge your auditors on what is contained within, and also to ensure that all areas are satisfactorily explained to you. In this slide, I've included links to the following auditing standards for any that have an inclination or need a technical point of reference for audit reports. So thank you for your attention. At this point, I think we can move across to Slido and see if there are any questions being posed. First question, see there, are CAMs required or going to be required for companies that are not pies? The short answer is no. I think that's really a matter of judgment between the audit committee and the auditor themselves. It's certainly not a one-size-fits-all. The introduction of CAMS into non-PI companies' audit opinions. If it would again aid to readability, understandability of the audit work done, absolutely. But I think it's a consideration for the auditor and the audit committee. Do we, audit committees, have responsibility in relation to CAMs? Consideration of what should be included as a CAM and what shouldn't. Again, as I alluded to in the presentation, no, you don't have a responsibility. It is the auditor's audit report, but certainly you should have the discussion with the auditor on what CAMs are included, what CAMs are, or if you believe that another CAM should be included or key audit matter, why is it not being included? And I think that conversation is very important. Can you explain what action IAASA takes where they see breaches that it noted in the auditor report? Maybe I'll just talk about from the perspective of an inspection. As part of any of the audit work that we would inspect, if we identify an issue in the audit report, depending on the severity of the issue, it could be deemed a finding and it would make its way into the inspection report to that audit firm on that particular audit that would have been carried out. So again, it depends on the severity of the issue identified in the audit report. Again, if it was at the very severe end and if there was a fundamental issue, that could potentially lead to an enforcement action. But again, I suppose it would want to be fairly severe. Does IAASA think there's an ideal number of CAMs? Again, I suppose I'll let you reflect on the slides later. What I did say was there isn't an ideal number. It completely depends on the industry, and it depends on the complexity of the entity itself. So as I said, we saw between 1 and 8, but for example, some of the regulated industries, you would see a higher number of CAMs because there's higher numbers of significant risks identified or critical areas that the audit team would be looking at. What would be required in the audit report as regards ESEF? As far as I'm aware, the tagging will be the very same as all of the other areas of the audit report, of the financial statements. So there will be, my understanding currently is that it is the intention that the audit report will be tagged. I think that is all the questions that I see. So thank you very much again, and I will hand you over to Kevin for the next session.